Just want to go through some of the other details of the reports before we get to some more discussion of that. And just wanted to re-hit the headline numbers because it is such a surprising report. 210,000 jobs added, very well short of the 550,000 consensus estimate. And by the way, that 210, I don't think there were any estimates that were that low. That I was looking at the dispersion and estimates this morning. I don't think I saw any that were that low. And again, we had a revision a little bit higher the prior month. Unemployment rate coming in at 4.2%. So that's actually a better number, interestingly, even as the participation rate just ticked up by 0.1%. Average hourly wages also very interesting, 4.8% increase. What does that mean? What are the implications of that? To me, at least, in some part, the implications of that are that even though we are seeing inflation tick up, real costs for real people, wages are not ticking up at a very speedy pace here, even as we see things like food costs going higher. Brian Cheung, I want to bring it to you first because of what I was saying about the Fed implications here. How should we be reading this report through that lens?
Yeah, well, within the context of the Federal Reserve, who had been signaling basically up until this report that they were essentially going to seriously consider quickening their tapering process to maybe set themselves up for more pull forwarding of their interest rate hikes in 2022. Yeah, indeed, if you're looking at this report and you're going, yeah, I wonder if I want to revisit that call. But on the other hand, when it comes to Fed communications, once the cat's out of the box, it's kind of difficult to put it back in there again. And I think for the Federal Reserve, even though I'm sure this is a disappointing report from the top line number, I think a lot of Fed officials likely would have liked to see something closer to the $500,000 range in terms of monthly returns, especially when you consider that 4.2 million, at least before this report, shortfall between current payroll levels and pre-pandemic levels. Then the Federal Reserve might still be saying, you know what, well, even though this is a bit disappointing, it's not a contraction in any way. The labor market is still at least bringing people back in. And for that reason, we've already communicated only a week and a half before the next meeting that this is likely what we're going to do. So, we can't necessarily just pull a pivot here and try to pull the rug out from under the markets based off of what we've been saying over the past few days. And I think one other thing that's complicating things is not even necessarily the data itself, but just the calendar, because that next Fed meeting, as you point out, Julie, is December 15. There's about 7 or 8 day blackout period ahead of that, which begins really essentially tomorrow, where the Fed will not be able to have officials speak publicly. So even if they wanted to rethink this, they couldn't say anything anyway. So I think with the communication they've already put out this week, really the train may have already left the station on perhaps a faster taper.
Yeah, here's my flash analysis here. At first, I thought the headline would mean that taper is not off the table, obviously, but maybe it's not as quick as some would think. But again, I think what you highlighted, Julie, with that wage growth, 4.8%, to me, that is inflationary. And I think that only feeds this narrative, this more hawkish narrative we heard from the Federal Reserve this week. And I would argue, guys, that is bearish for stocks. Bearish for stocks.
Well, we'll see how it turns out to be over the course of the session.